All right, so today we're going to be taking a deep dive into the world of bonds.
Oh, yeah,
You hear about them all the time, especially if you follow financial news at all.
for sure.
But what are they really? Like, let's imagine a big company,
Mm-hmm.
um, like Southwest Airlines needs a whole fleet of new planes, right?
Hmm.
We're talking millions of dollars.
Yeah, those planes aren't cheap.
How do they get that kind of cash? They issue bonds.
Exactly. It's kind of like instead of going to one bank for a giant loan,
Yeah.
they're basically borrowing money from a whole bunch of people at once.
So they're getting smaller chunks of money from like tons of lenders instead of one big bank loan.
Exactly. And each of those little loans is packaged as a bond.
Oh, okay.
So Southwest issues a bunch of bonds to investors, and that could be you or me,
Oh, cool.
and they become bondholders, and then Southwest uses that money to buy their planes, and in return, they promise to pay back that original amount plus interest by a certain date.
So it's like crowdfunding, but on a huge corporate scale.
Yeah, I like that analogy.
Yeah.
So the original amount they borrowed, that's called the principal, and the date they have to pay it back is the maturity date.
Okay. And just like any loan, there's a deadline.
Yep, bonds have a fixed term. It could be 5 years, 10 years, even 30 years.
Wow.
Depends on how the bond is structured, and at that maturity date, Southwest has to pay back the whole principal amount.
Got it.
And speaking of structure, bonds come in different, like ice cream. There's different flavors.
Oh, really? Okay.
Yeah, for example, you've got term bonds and serial bonds.
Okay. Now you're talking.
So term bonds all mature at the same time. Kind of like if you had a car loan and had to pay it off all at once at the end of the loan.
Right.
Serial bonds, on the other hand, mature in installments over a period of time.
Oh, so it's like you're paying rent or something.
Yeah, exactly. So you're making those regular payments.
Okay.
So if Southwest was financing like a massive new hangar or something,
Right.
they might choose a term bond knowing it'll take a while to generate the revenue to pay it all back at once.
Makes sense. But for things like routine maintenance or smaller purchases, they might go with a serial bond and spread the payments out.
Exactly.
Okay.
That makes sense. It all depends on their financial strategy and what makes the most sense for them.
Now, I've also heard about secured versus unsecured bonds.
Yes.
What's the difference there?
So that has to do with how risky the bond is.
Okay.
So secured bonds are also sometimes called mortgage bonds.
Mm-hmm.
They're actually backed by a specific asset, like, let's say, those new airplanes we're talking about,
Okay.
like with a home mortgage.
Mm-hmm.
If the homeowner doesn't pay the mortgage, the bank can take their house.
Right.
Same with secured bonds. If Southwest couldn't pay back the bond, the bondholders could claim some of those assets as collateral.
So it's less risky for investors because there's something tangible backing it up.
Exactly.
Unsecured bonds must be a little riskier then.
Yeah, they're based solely on the company's promise to pay like an IOU from a friend.
Okay.
And because they're riskier for the investors, they usually offer a higher interest rate.
So higher risk, higher reward.
Exactly. So if I were investing in a Southwest bond, I'd probably feel better with a secured bond.
Yeah.
Even if the interest rate was a bit lower, just less chance of something going wrong.
Makes sense.
Yeah.
Now, I am kind of curious about how these bonds are actually priced and traded,
Oh, yeah.
like in the market.
Yeah, that's where the concept of bond pricing comes in, and it can get pretty interesting.
I bet it does. And that's a topic for our next deep dive.
Absolutely.
Stay tuned. Welcome back. So last time we talked about how companies use bonds, kind of like those corporate IOUs, to raise money.
Yep.
We even talked about the different, flavors of bonds.
Yeah, like secured versus unsecured.
Right, in term versus serial.
Mm-hmm.
But today I really want to unpack this whole bond pricing thing.
Okay, yeah.
Because bonds don't just sit in a vault somewhere, right?
No, they're actively traded.
Like on the stock market.
Yeah, on a secondary market, just like stocks.
So it's like this giant flea market for bonds.
Yeah, kinda, yeah. People are buying and selling them all the time.
That's so interesting. So how do they actually determine the price of a bond that was maybe issued a few years ago?
Well, bond prices, they're not static.
Mm.
They fluctuate based on a whole bunch of factors, and one of the biggest is the prevailing market interest rates.
Okay, so let's say I spot a bond listing and it just says 100.
Mm-hmm.
Does that mean it's selling for its full face value, like the original $1,000 or whatever the company borrowed?
Yeah, you got it. A bond price of 100 means it's trading at its par value,
Okay.
but you'll often see bonds priced above or below 100.
Above or below. Why would a bond sell for less than its face value?
It all comes down to the relationship between the bond's stated interest rate
Okay.
and the current market interest rate.
Right.
Imagine you bought a Southwest bond a while back that pays a 5% interest rate.
Okay.
But now, new bonds are being issued are offering 6%.
Ah, so suddenly my 5% bond isn't looking so hot.
Exactly. To attract buyers, the price of your bond would have to drop.
Okay.
So it would trade at a discount below 100. It's the market's way of balancing things out, so investors can get a comparable return for their money.
So it's like finding a vintage treasure at a thrift store for a steal, because its true value is much higher.
Yeah, I like that analogy.
What about those bonds trading above 100, though?
So that's called trading at a premium.
Premium.
And it happens when the bond's stated interest rate is higher than the current market interest rates.
Okay.
So let's say market interest rates dip to 4%, but you're sitting on that 6% bond from earlier.
Now, my bond is the hot ticket.
Exactly.
Everyone wants it.
Investors are willing to pay a premium above 100 to get that higher yield.
So bond prices are constantly like doing this dance
Yeah.
with interest rates going up and down,
Tug of war.
like a financial roller coaster.
For sure.
You mentioned this thing called the time value of money.
Yes.
What is that?
It's a really important concept in finance that basically means that a dollar today is worth more than a dollar in the future.
Well, yeah, I mean, I'd rather have a dollar now to buy a coffee than wait a year for it.
Yeah. Right. Inflation is one factor, but you can also invest that dollar today and earn interest or returns
Oh, yeah.
so that by next year it might be worth $1.05 or more.
Oh, man. I wish someone had told me that when I was a teenager.
Well,
I spent all my birthday money on video games.
yeah.
I could be sipping lattes now with my investment earnings.
Well, it's never too late to learn.
That's true.
But the time value of money is especially relevant to bonds because bonds involve future payments.
Right, those interest payments and then that final principal payment.
Exactly. And those future payments are worth a bit less today because you could be out there making that money work for you
Right.
instead of just waiting.
So is that why bond prices tend to change over time, even if the interest rate stays the same?
That's a great observation. The closer a bond gets to maturity, the less those future payments are discounted.
Makes sense.
Because the waiting time is shorter, so you'll see a bond's price kind of move towards its face value.
As it gets closer to that maturity date,
Uh-huh.
so we got bond premiums, bond discounts, the time value of money.
It's a lot.
It's like a financial dance party in my head,
It's a dynamic market.
for sure.
There's one more piece we need to unpack, though.
Okay.
The relationship between interest rates and bond prices.
This is where I get a little lost usually.
Okay, well, remember the stated interest rate on a bond.
Yeah,
That's what the company promises to pay you, like the 5% we talked about before.
the one they print on the bond certificate.
Exactly. It's also sometimes called the coupon rate.
Okay.
But then there's the market interest rate, what investors are currently demanding for similar investments.
Okay, so two different interest rates.
Two different ones. The stated interest rate is what the company is locked into paying, while the market interest rate is constantly changing.
Based on all those different factors in the market.
Exactly. Economic conditions,
Yeah.
inflation, you name it.
How does this all affect the bond pricing, though?
Well, it's the key driver. If the stated interest rate on a bond is higher than the current market interest rate,
Mm-hmm.
investors are going to be lining up.
Right, because they're getting a better deal.
Exactly. They'll pay a premium, driving the bond price above 100.
But if the stated interest rate is lower than the market interest rate,
Then that bond is going to need some serious price adjustments to attract buyers.
it's going to have to sell at a discount.
Exactly below 100 to make it attractive to investors.
You know, the bond market is constantly reacting to all these different factors.
Yeah, it's like a giant puzzle.
Adjusting prices up and down to reflect what investors are willing to pay.
Yeah.
I have to ask, if a bond is issued at a discount or a premium, does that affect the actual interest payments the company has to make?
Ooh, that is a great question. That leads us to bond accounting, and we'll have to unravel that mystery in our next deep dive.
All right, welcome back, Bond Explorers.
Yeah.
We made it to the final part of our deep dive. Last time we ended on a bit of a cliffhanger talking about how those bond discounts and premiums actually get handled, you know, like from an accounting perspective.
Oh, yeah, for sure. So if a company issues a bond at a discount or a premium, there's some accounting magic that has to happen.
Right, because the financial statements have to, like, tell the whole story.
Exactly. So when a bond is issued at a discount, the company receives less cash up front than the bond's face value.
Mm-hmm.
And if it's issued at a premium, they receive more. So accountants need to track that difference over the life of the bond.
Okay, so hit me with a crash course in bond accounting, but try to keep the jargon to a minimum, please.
No problem.
My brain is still recovering from all those interest rate discussions.
All right, so let's say Southwest Airlines issues a bond with a face value of $100,000, but it sells at a discount for $95,000.
Yeah.
That $5,000 discount doesn't just disappear. It gets recorded on the balance sheet as a discount on bonds payable.
So it's like a little note saying, hey, we didn't get full price for this bond.
Exactly, and that discount is gradually amortized over the bond's life.
Amortized. I knew there had to be some fancy accounting term in there.
Well, it just means it's spread out over time.
So Southwest doesn't take a $5,000 hit all at once.
Nope. Each time they make an interest payment to the bondholders, a portion of that discount is also recorded as an interest expense.
So they're paying interest and accounting for a piece of the discount at the same time.
Yep, it's all about reflecting the true cost of borrowing.
It's like they're paying a slightly higher effective interest rate because they had to give that initial discount.
Exactly. Now what happens with bond premiums? Well, it works kind of in reverse.
Okay.
So if Southwest had issued that same $100,000 bond at a premium, say for $105,000, they would record a premium on bonds payable on their balance sheet.
So now it's like a little bonus showing they got more up front.
Precisely. And just like with a discount, that premium is amortized over the bond's life. But instead of increasing interest expense, the premium amortization actually reduces it.
So they're kind of getting a discount on their interest payments.
You got it, because they snag that premium price for the bond at the beginning.
Wow, bond accounting. This is way more interesting than I thought it would be.
I told you.
I feel like we're like financial detectives uncovering all these little secrets.
That's what it's all about. And understanding these concepts can really give you an edge, whether you're thinking about investing in bonds or just trying to make sense of the financial news.
Yeah, sure. Well, we've learned a lot in our bond adventure.
We have.
We've covered the different types of bonds. We've explored that whole world of bond pricing. We even did a crash course in bond accounting.
Not bad.
It's been an exciting journey. Thanks for joining us on this deep dive into the world of bonds. And remember, keep exploring, keep learning, and never be afraid to ask those burning financial questions.
Absolutely.